Thank you for joining us. This is the Market Beat panel for solar and PACE. We have an esteemed panel here to talk today about the subjects. I've had occasion to work with most of everybody on this panel, so I'm sure you're going to find it very informative. So we're going to kickstart it real quick by allowing each of the panelists to quickly introduce themselves, and we'll start with Rasul.
How you doing? I'm Rasul Alizadeh, President, CFO, President of Capital Markets and CFO at ARM Lending. My history in solar and PACE has been, I've been head of capital markets at Weigern Energy Fund and CFO at Fortify Financial. Also worked on some private transactions in the solar space and still am. So nice to meet you all.
Next up, Tara Crotty with Greenworks Nuveen.
Yep, thanks, Pete. Hi, everyone. It's great to be here in person. My name is Tara Crotty. I lead the asset management team at Greenworks Lending. Greenworks is a commercial-only PACE originator and capital provider. It was co-founded in 2015 by the architects of the Connecticut PACE program. The Connecticut program happened to be the first successful program in the country. They started Greenworks in order to help open the doors and grow PACE across the states. We've closed loans in more than 20 states. We were first to market with a securitization in 2017. And this past April, we were acquired by Nuveen, a subsidiary of TIAA-CREF. And that's why we are Greenworks Lending from Nuveen now.
Thanks, Tara. Next up, Eric Neglia with KBRA, a leading rating agency in this space.
Good afternoon, everybody. As mentioned, my name's Eric Neglia. I'm a senior managing director and head of KBRA's Consumer Asset-Backed Group. The group's responsible for new issuance ratings as well as surveillance of the ratings that we have outstanding. My group covers anything that touches a consumer asset. That could be credit cards, autos, unsecured consumer loans, as well as solar loan securitizations. Pleasure meeting everyone.
Thanks. And pinch hitting, thankfully today, literally last minute stepping in for a couple of people who unfortunately could not attend the conference, is Martin Glittman with Clean Energy Council.
Thanks, Pete. I'm Martin Gitlin. Yeah, I'm with the Clean Energy Council. I'm an attorney really focusing on, over the last 6 or 7 years, the solar as well as the PACE sectors. So I've got some experience on both. Unlike the folks at Winston that work with Pete and Pete's team, we don't do the securitization transactions themselves, but we represent a lot of the originators, both on the solar side as well as on the PACE side, putting the deals together that ultimately then go into the capital markets.
Thanks, Martin. Okay. So, folks, if you've been following this space at all, you know it is a highly desirable space. If everybody wants to be involved to a certain extent in something green, solar is something that at this point is pretty well defined. In the PACE sector, we are seeing enormous growth in commercial PACE. We are seeing significant headwinds in residential PACE, mostly driven by folks who, the mortgage bankers associations and the realtors associations have not been super fond about it. So what we thought we would do is we'd get started by giving everybody an opportunity to kind of touch on each of the various topics. We'll first start with the current state of the market. We'll then look at trends, and then we'll have everybody kind of go into outlook based on each of the different categories. So to start, we're going to start with Eric, and he's going to kind of give us his view on the current state of the solar market.
Sure. I'll start off with a couple statistics just on issuance volume. So since 2016, solar loan ABS issuance totaled $6.8 billion. Comparing that to solar lease issuance, which was about $4.6 billion, a difference of approximately 46%. Solar loan ABS issuance increased each year since 2016. Based on statistics that we have, lease issuance peaked in 2018 about $1.8 billion and then has stayed below $1 billion each year since. Year-to-date solar loan issuance is $2.1 billion, up 26% from the same time last year and up nearly 50% from 2019. As Pete mentioned, both sectors are attracting the attention of investors who are very focused on favorable ESG attributes. Solar loan ABS issuance is basically concentrated across 4 different platforms: Mosaic, GoodLeap or LoanPal, Sunnova, and then Dividend. There's one other major player Sunlight, but they haven't issued any public ABS. Mosaic and GoodLeap, they typically issue about 3 to 4 deals a year. Sonova about 2, and then Dividend hasn't issued since 2019. Deal sizes range from about 150 million to 400 million. Mosaic issued its first securitization in 2017, and then since that time issued 2.6 billion of solar loan ABS, which is slightly higher than GoodLeap, which began 2 years later and issued 2.5 billion in securitization. If you were to compare that issuance of those market leaders for the same 3-year time frame, you'll see that GoodLeap leads the pack there. They issued 2.5 billion, which is about 61% higher than Mosaic, and then 2.5 times higher than Sonova on the loan side. Just to level set around the solar loan product itself and what it is, it's a closed-end installment loan made to the residential consumers, and it's used to finance the purchase of the energy system. That energy system includes the panels, the inverters, the charging equipment, as well as the cost of installing the product. It's offered through an indirect sales model where the installers sell the energy system to homeowners. As part of that sale, they do offer financing through the solar loan companies, which I previously mentioned. These loans finance the entire cost of the system, so there's no down payment required from a borrower. Loan sizes typically range from about 10,000 to 50,000, depending on the system size. Loan terms are anywhere between 10 years and then have recently creeped up to 30 years. APRs are about 2.5% to 3% on average, but could range anywhere between 199 to 999. So these finance companies use promotional financing to drive the sales rather than risk-based financing, which we typically see when making consumer loans. They have a unique payment structure where they have a lower payment in the first 18 months, and that's because they expect a high level of prepayments around the month 18, and then the loan resets and then will reamortize. That reamortization and high prepayments is due to ITCs, the investment tax credit from the federal government, where it's assumed that borrowers will use that tax credit to pay down the loan. If they pay more than what's expected, they'll have a lower payment in the remaining term of the loan. If they pay less, then they'll have a higher payment for the remaining portion of the loan. Underwriting is pretty much based on 3 prongs: the equipment manufacturer, the installer, and the borrower. They perform an initial review on the installer and the equipment manufacturer just to make sure they're in compliance with their underwriting criteria and that the equipment will last the duration of the loan and won't have any mechanical breakdowns. On the borrower side, what we typically see is that underwriters focus primarily on FICO scores. On the consumer side, we typically see proprietary, sophisticated credit scoring models. In the solar loan space, it's primarily FICO-based underwriting, as well as looking at past credit history, such as the number of delinquencies, the number of credit inquiries, and then also payment to income and debt to income ratios. So that's kind of an overview of the state of the market right now.
Thanks, sir. Martin, maybe you want to weigh in real quick. You and I were talking about C&I and sort of the absence of C&I securitization in general. I worked on 2 deals that were going to launch, neither one materialized. What do you think some of the reasons are for that?
Thanks, Pete. Yeah, I think Eric hit on it just now when he said that the underwriting on these residential solar loan transactions were all about FICO scores. Well, that's an easy measure. There's really not such an easy measure on the commercial side. I mean, you can get D&Bs, you can get Fitches. There are ways of assessing the credit of a commercial entity, but it's a lot harder. It's not easy to do in volume. The commercial deals tend to be larger as well, a little more chunky. So the credit analysis becomes a lot more about a more holistic analysis of the credit of the off-taker, or the borrower in this case, as well as, because the systems are larger, a more close look at the installer as well.
Thanks, Mark. And then, Tara, maybe you kind of fill us in sort of, it sounds like residential solar is doing really well. C&I solar for securitization purposes, not so much. How's commercial PACE doing?
Yeah, thanks, Pete. So as far as securitizations, other than one public deal that was completed a couple years ago, most securitizations are done in the private market. And so there's not a whole lot of public information about them. I'm going to talk about it a little bit later. I think we're going to see a transition there. You're going to start seeing more 144A issuances coming up due to a greater expanding investor base and more historical performance data that we have on the loans themselves. According to an article that DBRS published a month ago or so, they indicated that they rate pools of loans from 5 different issuers. Greenworks issued its first securitization in 2017 and issued a second securitization in 2018. We've done some subsequent upsizes to that 2018 securitization. The structure of it has been single tranche, delayed draw, fixed rate structure with both of our securitizations were rated by DBRS, and I believe it's a consistent structure across the board. Drilling into the asset class itself, there's been a tremendous amount of growth for commercial PACE. In 2020, there was over $2 billion of issuance closed. This is a 35% increase from 2019, a 135% increase from 2018. Over the last year, there's been 4 additional states that became active in the commercial PACE space. This brings it to a total of 22 states plus Washington, D.C. There are 15 additional states that have passed legislation but are not yet active. The average size of the loans, it will vary across the different originators. In general, though, across the board, the average size is increasing. This is due to the fact that there's a huge demand for new development, gut renovation financing. And with that, there's a lot more eligible measures for new development and gut renovations. You can fund the cost of the envelope, any underground plumbing. You can fund the cost of windows, doors, that kind of stuff, and also seismic in California. So there's just a lot more measures that you can fund, which drives up the amount. But still, across the board, it still remains under 25% of the value of that property. As far as performance goes, performance of commercial PACE has been pretty good, been very good. We didn't see a spike over COVID. Greenworks did work with our property owners who were experiencing some impact from COVID, and we worked with them to either give them an extra grace period to make their payment, or to we ended up amortizing or re-amortizing their loan, pushing out their payment dates to the next period. We found it to be mutually beneficial to keep them in their building and to continue the operations. And nearly all of them are now repaying on the amortization schedule and are current on their loans. When we do see delinquencies, they tend to be short-term. They tend to be around 60 or 90 days, and they tend to be due to administrative errors by the property owner. Either they got the bill and they forgot what it was, or their escrow agent didn't make the payment or something like that. And what we end up doing is giving them a call. As soon as we do, they make the payment and they become current. In the article that DBRS released last month, they indicated that through their rated portfolios, there's been 0 principal losses. And out of the 700 loans that they rate, only 10 of them have been delinquent or are currently delinquent.
Thanks, Sarah. Yeah, I tell you that as a firm, we do a lot of CPACE. We've seen all the different flavors of private deals. Life insurers are highly interested in the class. As they've often told me, there is more demand than product, though as Tara rightly notes, that is changing significantly. We can get into some of the motivations as to why developers are coming into this space. But the CPACE market is exceedingly strong, and its performance is really, really good. So it is one of those great bright stars for the green space. On the other hand, the RPACE sector, which, fairly or unfairly, has definitely gotten a black eye over the last couple of years. And so I'm going to let Rasul tell us what's going on in the RPACE space.
Yeah, and I'll say, when I was at Y-Green, we also did small balance commercial transactions. And the mindset around CPACE was also that, at some point in time, and it seems like it's starting to get to that point, it could be an alternative to mezzanine financing or you know, any kind of subordinate financing that may be there. The competitive pricing that's been there for years has been, you know, a challenge in some capacity, especially at least in a small balance commercial space. As time is changing and there's more receptiveness to this concept, you're seeing more and more folks move in that direction and look into portfolios in that direction on the CPACE side. Now, coming back to the RPACE side, you know, issuances have been around since 2014. There's been really good investor support in the space, especially on the asset-backed side. There's a good loyalty of investors who continue to be repeat investors in the space. Once they've spent time understanding it and getting to understand kind of the legalities around it, the protections that there are in place for those type of transactions, they understand that there is noise around it, but the asset is a safe asset once it goes into a securitization. That safe asset has been performing extremely well. So from a structural standpoint, these deals have had, you know, 3 tranches. They've shifted into a 3-tranche type of issuance, A tranche, B tranche, and a C tranche. The A and B tranche usually is 97% advance rated. The B tranche is around 3%. And then the C tranche actually steps up in a premium on the excess spread and gets you up to about approximately 110. And that goes down to a BBB rating, usually in that space. Primarily because the losses are very low. As you heard here earlier on the CPACE, very similar to RPACE. You know, you can lend up to, I think it was 80% or advance rate, or actually you're qualified to borrow at 80%, and then combined LTV can't go above 100. It's a first lien position on the property. It's one payment's being made per annum. So if you miss that payment and you go into a delinquency, the property is sold, it's only those payments being repaid. So it kind of really manages the risk around that asset from an asset perspective. The challenge that it's had in the black eye that Peter was mentioning has been really mortgage folks don't like being primed, and there's a lot of, you know, angst around that. The PACE market really looks at this and says there's consumer protections in place. They're doing a lot of self-regulating around that on the RPACE side. They started a little bit late in doing so, but in recent years as a result of that, I think they've done a very good job of putting protections in place for consumers. California laws have been put in place to require that, but there's still this kind of dynamic tension between mortgage providers and PACE providers. And so as a result of that, mortgage providers have deep pockets typically, and you can see that sometimes they can lobby against it and put laws in place, some of them rightfully so, to make sure consumers are properly protected. Some of them just make it very challenging for the space to grow into other states. Currently, our PACE started in California, moved to Florida, then Missouri, and recently Ohio. There's some noises around Pennsylvania, Texas, New York, potentially coming in soon here. But at the same time, it's just been very slow and sluggish to get more states to adapt. And solar market has also done a good job of kind of competing on the solar side, which PACE can provide financing for as well. Home improvement markets have started growing on the unsecured side, which has made it very hard for folks to look for alternative financing like PACE to allow the legislation to change. And it's made it very challenging for the space to grow. Some of the early on issuers aren't as strong in terms of volume as they used to be. One of them is no longer even around. Companies like Wygreen have done a good job really building a balance sheet. Fortify Financial, even PACE Funding, who's now, I believe, Home Run, have done a good job of at least managing the balance sheet or building balance sheets, holding some of those residuals on their balance sheets to create a strong balance sheet to be able to grow with their lenders. That's allowed them to survive and continue to grow. But the challenge on growing in the space has been tough. And so you're seeing some movement, some pivots from some of these folks. I believe Home Run or PACE Funding has recently moved into the home improvement space as well. Wygreen continues to grow their commercial portfolio. As you know, mentioned earlier, you're seeing a lot of movement in that space. And I believe some of the other folks are still trying to figure out the next phase of their movement and pivot. But it's been challenging, and it's going to continue to be that until you see some disruption in the unsecured space, and that's kind of my anticipation on that front.
I as recently as Thursday or Friday, I had a conference call with the executive director of PACE Nation. I don't think he's convinced that our PACE will go away but it is certainly meeting challenges right now in terms of being able to open up other markets. To be clear, that some of the things that were just, I want to contrast and make sure you guys see a couple of things. In the R-PACE market, it is heavily a 144A market. There's been private deals, but it is a 144A driven market. You've got great granularity, and even though you don't have as much geographic diversity by state, you've still got pretty good diversity within the states that are in the pool. The C-PACE market, as Tara noted, is primarily a direct placement market with insurers. The R-PACE market has no lender consent, which is to say it's impractical to tell somebody that to go and get lender consent for a $25,000 solar panel on their home. You're not going to call Wells, City, or whoever and say, hey, I need you to consent to this. So they've relied on what's called a validation process for saying that they're priming those mortgage holders, and that's what's upset a lot of the mortgage associations and the realtors associations. In the C-PACE sector, it is overwhelmingly the case with a couple of exceptions. You do get lender consent or acknowledgement, and that makes sure that everybody plays nice, and that's why C-PACE is in almost 40 states today, with 22 primarily active, but at least it's in 40 states today, because you've got buy-in from the lenders on those transactions. So those are some of the dynamics that we're seeing between R-PACE and C-PACE.
Let me add a couple things to that. I think from a issuance standpoint, $7 billion, I think, to date, and since 2014. Most recently, I think it was like $770 million. I think this year will be something similar to that. So, you know, the market is shrinking. I think the peak was maybe $2 billion in a year was issued, and it's gone down in terms of issuances. But the liquidity in those bonds are still there. People are, as I said, are trading them, they're purchasing them, and they're seeing good assets. And that is just a smaller market. So it's hard to throw a big name kind of investor with a lot of money to put to work behind that, because it's tough to move those bonds around. It's too much time to put into learning about the industry or being comfortable with the risks that are being mentioned on that. When it comes to the consent piece of it, it's just challenging in that space, right? Because you're doing $50,000 type loans, home improvement type loans. You're trying to get folks to, you know, move fast. You're competing with solar. You're competing with unsecured. Those folks are getting approvals within minutes, different type of dynamics around it. Because you're taking that first lien position, of course, people want to get that consent. The lender, the mortgage provider wants to have that understanding of what's going on. Although that most PACE providers in our space do notify, it still makes it very challenging to compete if you go for the consent. The consent just delays you a long time. The view of the PACE market has been, you know, you're doing $50,000 loans, you're doing, you know, 25, 30 year on average type transactions. So you're talking about $2,000 a year. If you go, you know, bankrupt on that home for some reason and that $2,000 a year payment is missed, it's only that payment that has to be repaid. And at that point in time, you can go and pay, sell the house and pay the mortgage entirely back. So it's a very small amount of change into that potential equity that the mortgage providers are nervous around, but it does cause that dynamic and tension that Pete mentioned.
And just one other difference. The resi market is very similar to the solar market in the sense that the people who are pushing that product are the installers. The C-PACE market does not rely on the installers. It's going directly with the guy who owns the property and is building the property. So again, different dynamics between what is otherwise in substance the same product, just operates very differently. Do you have something?
Yeah, can I just add a little bit of color to the solar piece of our PACE versus solar loans? You know, what we've seen some interesting things through the pandemic. During the first basically year of the pandemic, you know, as Eric suggested, the solar loan market was going pretty well. We saw a number of rated securitizations come out during 2020 and certainly here in 2021. At the same time, talking to my residential PACE clients, what I've learned is during the lockdown, when bank markets were essentially closed to homeowners, you know, home equity lines were not available, refinancing was tough, PACE went from being really a second look product in many cases to a first look product. And the volumes during the lockdown period of COVID were pretty strong for a number of the residential PACE providers. But there's an interesting thing that's happening, which is you can get a solar loan at mid twos, even lower with promotional pricing, if you've got a 750 FICO score. But if you have a 695 FICO score or 720 FICO score, That's a little tougher. I mean, these solar loan securitizations, to get that average at 750, doesn't leave a lot of room for the lower FICO score borrowers. PACE, on the other hand, doesn't look at FICO scores at all. What it looks at is the value of the property, and then now with the new consumer regulations, not so new anymore, ability to pay, which is a slightly different calculation than a FICO score. So what we've seen on the solar piece, as well as on the other measures that are financeable on our PACE, is a bifurcation somewhat, where the folks with the higher FICO scores can get a lower rated product. I mean, PACE, although you can get promotional interest rates on PACE, they tend to be a little higher than what we're seeing in solar loans. And if you're getting a lower interest rate, you're probably buying it down and paying cash for that. So ultimately, the money's coming from the property owner. So we're really seeing a bifurcation. Now what's happening is the bank markets are opening again. And the PACE, the Resi PACE, particularly for solar, seems anecdotally to be slowing down some. So that's a really interesting dynamic that we've seen between the two different products that are essentially financing the same thing.
Yeah. So let's you kind of touched on trends. Let's go to Eric, and Eric, maybe you could tell us where the trends are today for solar, and where you think it's kind of going.
Sure. As a rating agency, one of the first trends that we monitor is the credit performance trends. And as Tyra mentioned, credit performance through the pandemic has been solid. We've seen low level of enrollments in hardship programs. We've seen low level improving delinquencies and loss rates similar to what we've seen across other asset classes. But it was notable given the quality of these borrowers, the fact that they're homeowners, this value proposition. We've seen performance trends improve throughout the entire pandemic. And then during that time, we took no rating actions. There was no negative rating actions within the sector to date. As I mentioned, we're seeing low level of delinquencies. They're typically 30-plus delinquencies, less than 1.25%. And again, due to high borrower credit quality. I touched upon this value proposition, and that adds to it as well. And basically what that means is that the customer is receiving a benefit through a lower cost of electricity compared to receiving that electricity from the grid. So both in terms of our assessment as well as the performance of the sector, I think having that strong value proposition has helped with the borrower's willingness to pay. Our lifetime expectation for CNL for the solar loan space is somewhere between 6 and 11%. Clearly, that depends on the pool quality. That if you're going lower in FICO, that's going to go higher. If there's stronger underwriting characteristics, that's going to go lower as well. We base this off of actual performance as well as some proxy data that we were able to gather of similar loan products. But definitely the limited performance data is a key consideration in our analysis. But I would say in general, the sector continues to mature, continues to develop, and I think it reassured a lot of investors and market participants about the quality of these loans through a credit downturn. One other thing that we're kind of observing is recovery rates, and we're seeing strong recovery rates within the sector. Our assumption on recovery rates, so after the borrower defaults, is anywhere between 3.5% to 13%, and that's expected to occur over a 24-month period. Recovery rates that we're observing and the trends in recovery rates are primarily driven by the ability for a servicer to disconnect the system. And by disconnecting the system, if there is a strong value proposition, the borrower will want to begin making payments to kind of tap into the lower energy costs. So if a borrower defaults, the servicer will make that argument to them. If they see it, then they'll start making loan payments once again. And then the other level that helps in recoveries and the strong recovery trends that we're seeing is the filing of UCC and county fixture filings. And what that does is if the borrower goes default, there's a notation within the title search, and then that prompts the borrower to renegotiate with the servicer in order to sell the home. So from data that we've seen, probably 20% of recoveries come from reoccurring payments, so the borrower realizing the value proposition, starting to make that payment again, where 80% are in more of a lump sum recovery, primarily associated with a home sale or an insurance claim.
Can I add a couple things to that? So what's interesting is I've been working on a couple of portfolios and seen some assets from Lone Pal and Sunlight and so on and so forth. Building off what Eric just said is, as a result of that performance and them coming through the pandemic in a good way, I think it was very well received in terms of the fact that, you know, they performed fairly well in that little blip that we saw in terms of unemployment spike and then going back down. Those credit unions, private banks, they're very much interested in these assets, and everybody's looking for assets to add to their portfolio, so it's making it, you know, much more competitive in terms of pricing. And even as a result of that, some of the folks on the private side, you're seeing a lot more of that box open up a little bit more. So as opposed to saying nothing below 650 FICO, now you're seeing folks accept 640 FICO, 630 FICO, as opposed to saying, okay, 750 is the average I need. Oh, maybe 730, 725 is an average I can live with. And it's just because of that performance, it's made it a little bit bigger box. It's opened up a little bit more opportunity to lend, and as a result of the pricing also coming down, you're seeing those solar loan folks go out there and be more competitive to compete against each other to win those loans with lower pricing as well. So it's an interesting dynamic. I think you'll see a little bit more of that, you know, just given where the economy is and things are as of today. But it'll be interesting to see if there is a, you know, interest rate spike or, you know, any kind of benchmarks that kind of start going higher, how those credit unions, how those banks react, and what that's going to do to the marketplace. I think when that happens, if you see a significant increase, you'll see people turn back into the securitization space a little bit more. Right now, I think it's about 55-45, maybe split between securitizations being the lower of versus private deals happening in that space in terms of volume.
Thanks, Russell. Tara, do you want to kind of give us the current trends on CPACE?
Sure, yeah. Okay, so I have a few trends that I want to mention. One is new construction that I talked about before. It continues to grow. We're finding that developers see this as a necessary tool to complete their capital stack. It's a good, cheaper alternative than mezzanine debt and equity. So, and the second trend that we're seeing is an increase in retroactive financing. Retroactive financing is the measures are complete in the building by the time we close the PACE loan. What's driving this? It varies. Sometimes, mostly it's due to the property owner wanting to liquefy their investments, especially during the uncertain times through COVID. The second reason is wanting to refinance out of higher debt, higher rated debt. Greenworks likes retroactive financing because it mitigates one of the risks that we look at, which is completion risk. For new construction, what we do for that, we disperse along with value as value is being added to the property. So we every time we get a disbursement request, we're reviewing the inspection reports and we're dispersing along with the senior lender. The third trend that I want to mention was an increase in municipalities passing ordinances that require building owners to meet certain energy standards in their buildings. CPACE is a good option for them because you know it's a good option for them if they don't have the cash to pay for those measures or they don't want to take additional debt out to pay for it. New York City is an example of a city that passed these ordinances. And they also just became active in the commercial PACE market as well. Greenworks actually just closed a loan there. We closed a CPACE assessment on a Midtown Manhattan office building. It happens to be the TIA Nuveen headquarters. It was a $28 million loan, and we were funding the cost of new roof insulation, lighting, and smart windows. Smart windows are those windows that tint along with sunlight to conserve energy. So we were really excited about that, and we expect to have a lot more of those types of projects soon in New York City. And then the last trend I wanted to mention was the increase in the investor base. We're definitely getting a lot of inquiries from ESG type investors. Greenworks had engaged Standard & Poor's on a green evaluation on both of our previous securitizations. And the results of that, they gave us the highest impact score that they give on their scale. Their analytical review includes a look at all of the measures that are going in the buildings. What kind of energy is it producing? Is it green energy, energy efficiency, or is it resiliency measures? And they look at the location, and they take those components and they compare it to a baseline assumption. They also take into account like verification measures, and they take into account reporting and that kind of stuff. They also indicated that that PACE is aligned with green bond principles. So this is also something that ESG investors I know are looking for as well.
Thanks, Tara. So we're just under 10 minutes, so we did start a few minutes late. You want to take 2 minutes or a minute? Real
A
quick?
minute.
Minute, go.
Two quick points. One is drawing that distinction between resi and commercial in solar loans. Eric mentioned that in solar loans, if they don't pay, you can threaten to shut them off. In commercial, you see more PPAs than loans and leases, third-party ownership. If you shut them off, you run the risk of an ITC recapture. So you don't have that tool on the commercial side. In solar generally, though, one of the things I wanted to share with this group is something we've been seeing in our firm across the board, which is for projects, significant delays in procurement caused by the COVID-related supply chain challenges. We've renegotiated a number of lines of credit to extend out deadlines because projects just can't be done quickly enough because they can't get the materials. I mean, obviously there are some who've safe harbored materials. They're in warehouses to get higher ITC, but that's sort of running its course. So I caution folks who are looking at this market that there may be some blip over the next couple of quarters till the supply chain can catch up with the demand.
Thanks, Mark. Okay. So we were going to do a future sort of outlook part, but I think we've somewhat covered it in the trends, and I want to make sure we give everybody the opportunity to ask questions. So why don't we open up the floor to questions for anybody that may have any questions? Anyone? Otherwise, we're going to keep talking about future outlook. Okay, well then we'll really quickly go through future outlook. All right. So, Eric, future outlook for solar?
For residential solar, I think the primary outlook is higher originations. I think the trends I mentioned earlier on about origination growth will continue in the foreseeable future. I think that's primarily driven by the familiarity with the product, the acceptance of the product by the consumers. They're more familiar with the solar systems. They see it on their neighbors' homes. We're seeing technology improvements as well, and cost comes down. So they're willing to make the investment in solar power. I would also say, the growth in this sector is being driven by a desire to become energy independent. As you see wildfires, you see rolling blackouts, you see hurricanes and ice storms, and people question how reliant do they want to be on the grid. So they can become energy self-sufficient with the solar panel as well as by purchasing, battery and storage add-ons. So I think that kind of is another factor that is going to drive growth. And then just given the reliance on 144A issuance, I see that market growing as well. Also seeing the loan term and balance increase. In 2017, the average balance was about $27,000, and the loan term was about 20 years. That's now up in the range of $34,000 average loan size and 25 years. So, pretty significant increase over a short period of time. And what's driving that growth is really kind of the add-on. So it's no longer a pure solar loan issuance. There's starting to be kind of solar plus battery, solar plus energy efficiency, remodels like LED lighting, HVAC, windows and doors being added into that product subject to a certain limitation. So I think we'll see more of that. And then I think, as you touched upon a couple times, panelists touched upon here, is kind of moving down credit. I think it's partially driven due to the strong performance that we're seeing, but I also think it's being driven by the current administration's desire to promote green energy, promote environmental benefits, and then also financial support for those that need it. So I do expect to see a move down credit tier, whether that's an extension of the existing product or there's another way of financing it. But I think there is value in solar energy, and that value would benefit lower income, lower credit spectrum borrowers as well.
Thanks, sir. Does anybody want to give an outlook on CNI solar, whether we think that's going to start coming to securitization?
I think for the reasons that I mentioned at the outset, it's going to be tough to get the kind of volumes you're going to need for securitization. I think that there's a vacuum to be filled in the CNI sector. I suspect we're going to see more PPAs than we're going to see solar loans. Commercial entities tend to have access to capital that might be, reasonably priced and competitive with solar loans. PACE is an option, but it's expensive and has high transaction costs. Look, commercial CNI solar is going to continue. The other thing we're seeing a lot of, particularly in markets like New York, is community distributed generation. So companies that want to go solar can do it with a subscription model rather than an asset model. So CNI solar will certainly continue to proliferate. The question is whether someone will fill that gap and generate enough of a product that's homogeneous enough to go into the ABS markets. And I think there's a big question mark there.
Yeah, certainly the two deals that we worked on were not even close to homogeneous and never really got out the box. Tara, sounds like things are going well in CPACE and the future looks bright.
Thanks, Pete. Yes. So two things I wanted to highlight here. One, what I mentioned in the beginning was the market transitioning from private to 144A issuances. There's two things I think that are driving this. One is the expanding investor base. Initially in insurance, and they still are interested in it. Their interest in this is due to the steady and predictable cash flows, super seniority on the property, super senior lien on the property, and low prepayments. But this is expanding now to impact investors who are looking to fill their portfolio. And then the second thing is just having historical performance data now. It's been very strong, especially during this COVID credit crisis that we just experienced. So having that, along with some foreclosures and bankruptcy, having that kind of experience has been good. No one likes to see foreclosures or anything like that, but to go through that, and it makes it, you can prove that it's a good, it proves that the PACE lien is working the way that it's supposed to be working. So in our case, in our situation, what happened was once the foreclosure settled, we became current with our PACE assessments, and then the new property owner that came in started to make the payments when they came due and on the original AMOR schedule. And then the second highlight that I wanted to mention was just overall growth. And as I mentioned before, there are 15 states that passed the legislation, but they don't yet have active programs. So that they're currently developing their programs right now. And then the second thing is the ordinances that the municipalities are passing that mandates their building owners to meet certain energy standards. Otherwise, they're going to face a fine. So New York City, I read an article the other day where it said that in New York City, who is experiencing this right now, there's 50,000 buildings that are facing this kind of mandate where they're going to have to make these upgrades. And this translates into an $80 billion in investments needed in order to help those property owners renovate their buildings.
Thanks, Sarah. So, Rasul, we've talked about some of the not so great press for our PACE, but there was actually an encouraging story not that long ago about a credit union that wanted to partner on PACE as part of their senior lending platform. What do you think the outlook is going to be for our PACE?
Yeah, I think if there's more and more credit unions or even regional banks that accept our PACE into their portfolios, it'll open up the door more because some of those legalities in the states may shift because some of the consumer protections are already there by the requirements in those banks. But I think overall, it's going to be more states coming on board. That's where the outlook has to be. I mean, if you add Texas, Pennsylvania, Illinois, in New York, just right there, along with Ohio already being in place, it could change significantly the potential volume that's available in that marketplace. I think Ohio, how receptive it is to PACE, how potentially it can grow, can give maybe a little bit better, plan or schematics in this new world of the R-PACE that they're experiencing to see if they can expand into more states. I think if New York kicks in, it could be a significant game changer for them as well. But there's a lot of ifs still there, and so I think overall the marketplace is kind of at an interesting point on the R-PACE side. Volumes will keep coming in, like you said earlier. I believe that there is a place for R-PACE. I think R-PACE has been beneficial, 280,000 plus deals done in that space, over $7 billion. That's no joke. And they've done well, and it's been very helpful. Yes, it's had its challenges. There's been some noise around consumer protections and consumers in general. There's been some challenges around the installers and how they've been managing the potential financing and how they've been representing it. But I think they're doing as best as they can to get in front of those and make sure that it's being represented accordingly. Now I think it's now a matter of getting into the states. And if they can do that, the volumes will start growing, and there'll be a healthy competition between that and unsecured lending over time.
Thank you. All right, we've got 45 seconds. Somehow it bumped up. Any last minute questions? And we can go ahead.
I was just wondering, what kind of analysis do investors typically do for solar and PACE? Is it mostly just simple cash flow modeling, or is it something more credit based? I know
They're different. Yeah, I'll let the guys answer in detail. They are different, right? As Martin said it earlier, in the PACE sector, if you're doing a residential PACE transaction,
Yep.
you're looking at the DTI and the value of the property. In the solar structure, I think you are doing effectively an unsecured consumer analysis, but
Right, which is the proprietary model that you guys were talking about, at least.
correct.
And who are some of the, players in that space? Like, who are the people that provide these? Is it mostly Intex? And I was just curious.
Are we talking
Is
about
that
the data?
something
Who does the data crunching?
Well, yeah, I think the transactions that are in the marketplace, they typically are on Intex, and some of them you'll see some representation of it on Bloomberg as well. I think rating agencies do a very good job of tracking performance and history on that. On the PACE side, it's the credit isn't a huge underwrite from the perspective, as long as the legalities and the logistical aspects have been done right. The asset itself is pretty strong because you are a first lien position. 15% max LTV on that, and so you're really kind of, a lot of things would have to go wrong that never historically have gone wrong for you to lose money on that particular transaction. Knock on wood on that front. But on the solar side, it is more of a credit underwrite, and I think that aspect of it, you do see a little bit more cushion needed, a little bit more credit enhancement needed. The yields on those assets I mentioned earlier are a lot less. And so as a result of that, you have to get additional credit enhancement to support the rating agency requirements and make sure there's proper support there. So it's much stronger credit underwrite on that front. And PACE is more dependent on just the assets itself and how they can move in terms of potential interest rates and the protections they have in place on that. So when you're looking at a PACE company, it's really going to be more about the type of business that they have set up. You're looking more at the front end of the business. Not to say you're not doing that on the solar side, but the credit underwrite of the borrower is going to be much stronger on the solar side.
Great. Thank you.
And I could just give a quick plug for KBRA's website. If you have any questions on our analysis, it's all available on our website, and it's included in kind of great detail, both in our new issue reports as well as our surveillance. But on, we go into an analysis of the originator, the underwriting, historical performance data. We do cash flow modeling for each of the bonds, and in our rating assessment. So it's kind of all of what you've mentioned.
Do you guys have a white paper for that on the website?
We have industry updates, we have research reports, we have new issue pre-sale reports, and very thorough surveillance reports as well. So you could just search by issuer name and it'll pop up.
And on the Resi PACE side, there are other rating agencies. KBRA, I don't know that you've done many of the Resi ones, but for PACE. But you can find some of the other agencies that have done reports on Resi PACE.
Yeah, and on the quick plug for the commercial side. Well, we look at three components when we're underwriting our PACE assessments. We're looking at the long-term risk, right, of loss. So we're looking at the property value. We're looking at any environmental concerns there. We're looking at RUCA code, like how far are they away from city? Like how likely is it to be able to sell this property in the event of a foreclosure or a bankruptcy? Then we're looking also at short-term risk, the borrower's ability to repay. We're looking at LTV, DTV, those kind of things. And then last, for new developments, and most of ours are construction type deals, so we're looking at completion risk. So we're managing our disbursements to make sure that we disperse along with value as value is being added to the property. And I know that DBRS also has some reports that you can look at specifically for commercial PACE.
KBRA definitely has done a lot of resi pace as well, just to throw it in there.
Thank you, Rasul.
There
I
you
was
go.
that's what I was going to mention.
Okay, there you go. Okay. I saw that they handed you the mic, Cecil. Anybody else with a question? Oh, go ahead, right there.
On senior lender consent, are these, for CPACE, are these lenders generally enthusiastic? Are they, not excited about providing these consents? Are they consistent in documentation? Maybe you could speak to that.
The forms tend to be short. I wouldn't say that they're, plain vanilla from lender to lender, but there is usually a form that everybody tries to kind of stick with. And my experience has been that if you're dealing with a regional lender or a lender that's got a good relationship with their borrower, they're often motivated to want to work with their client and keep them happy. I think in general, the markets have discovered that if your mortgage loan is in a CMBS, that's tough slugging. The CMBS servicers do not want to be bothered with PACE. And so that has continued to be a challenge for the industry, though I am aware of one PACE provider that was able to get a CMBS servicer to provide the acknowledgement or consent. Generally speaking, it's a relationship-driven thing, and most lenders want to keep good borrowers happy, or they can see the advantage that it provides to borrowers. Tara, do you
Yeah,
see?
no, I would agree with what you're saying right there. And also, the lenders are seeing this as value added to their property. So, we're not taking, so they'll see value added. So that's one reason that they're agreeing to it, and they want to keep their borrower happy. Yes.
Any other questions? Okay. Fantastic. Thank you, folks. I appreciate the indulgence, and I wish you all a great conference and afternoon. Thank you for joining, and thank you to our esteemed panelists for volunteering. Thank you.